Business owners likely will have only one shot to sell a business. Most don't understand what drives value and how buyers look at a business. Until now. Welcome to the How to Sell a Business podcast, where every week we talk to the subject matter experts, advisors, and those around the deal table about how to sell at maximum value. Every business will go to sell one day. It's only a matter of when. We're glad you're here. The podcast starts now.
Welcome to another episode of the How to Sell a Business podcast. And I'm your host, Ed Mysogland. And this is that time of the quarter where we talk about market multiples. So the most recent DealStats just came out last week, and I wanted to share a little bit about its findings. So I often get calls from accountants, attorneys, coaches, financial planners, people that are working with small business owners, and everybody wants to know what's going on in the market and what are the market multiples saying. So this is an opportunity for you and for them to see what's going on across the markets. Okay, so here we are with the DealStats Value Index of the first quarter of 2023. And the first thing that I want to draw attention to, and by the way, I will have a link to this download. And if you head on over to YouTube, you can see this presentation in its entirety. So the first thing I want to draw attention to is in the third quarter of 22 versus the first quarter of 2023, the EBITDA, so earnings before interest, taxes, depreciation, and amortization of private targets decreased from a multiple of 5.6 down to 4. And that's a pretty significant drop. But again, if you look at the cost of capital, that could explain a lot of why the multiple dropped, as well as you've got cost of capital, as well as risk in small business as a result of capital and supply chain and such could have caused the decrease. So a decrease in multiple indicates that there's an increase in risk. All right, so now let's move here to net sales multiples. So the funny thing is, in 2022, it was the highest ever recorded at 89%. So that's almost 1 times revenue, if you think about that. And from having done this business for 31 years now, that is an insane number. I mean, most businesses do not trade at 89% of revenue. So you could see that there was a lot of people making some pretty aggressive purchases at the tail end of 2022. But now you see that it's kind of reverted back to the norm. So it dropped from 89% of revenue down to 58%, which is roughly median. So I guess my point is that that what we're seeing in the market multiples are not necessarily and let me back up. When we're looking at our business owners and we're communicating value, a lot of times what we're finding is, they're using bad data, or they've heard bad data. I can tell you that some of the, being an appraiser for as long as I have, it's not normal for big swings like this to be used as proxy for value. There are reasons why it can get up to these types of multiples, but I don't want to say they're extenuating circumstances, but there's reasons why there are attributes of the business that cause it to increase in value or increase the multiple for the value. And it just depends. But for a median multiple to jump as high as it did for quarter 3 and 4 of 2022, to me, that's going to be an outlier, at least at the moment. We're seeing that values have kind of reverted back to normal, at least what I think is normal, because small businesses tend to have generally the same amount of risk. And before you jump all over that comment, I say that from a median multiple standpoint. There are reasons why why that multiple will increase or decrease depending on the specific attributes of the business. So I'm only speaking as far as median multiples. All right, let's take a look at EBITDA margins. This is also another remarkable number. And EBITDA margins, so that's EBITDA, so earnings before interest, depreciation, and amortization. And that's divided by revenue. And so that margin there is, if a business is running 10 to 15%, that's a really pretty healthy company as far as I'm concerned. There's opportunities for upside to help the businesses increase that margin. Post sale, that's a reason why a buyer would buy, is because there's room for upside. But in this case, the EBITDA margins have gone, and this is again back to quarter number one, up to about 25%. So 25% of every dollar is going to EBITDA. To me, that is, I haven't seen that ever. I've seen companies have it, but I've never seen as a median that you're talking roughly 25% of EBITDA margin as of first quarter of 2023 is running that high. And in fact, it's the highest recorded figure ever by DealStats. And so to me, I'm having a little bit of, pumping the brakes on why is this happening? And so that's a big number, and I'm not certain it's sustainable, because it typically, you're typically running anywhere from, like I said, 10 to 15% is normal. 20% is a really well operating company, but 25% as a median seems high to me. But nevertheless, the data is what it is, and as 2023 progresses, we're going to figure out whether or not this is sustainable. Okay. The other interesting thing is, out of all the sectors that DealStats tracks, what we found is only two industries increased in multiple, and that is information technology and finance and insurance. Everybody else went down or stayed the same. So next I wanted to talk about just the multiples, in the multiples from net sales. You can see that, it's generally a general rule of thumb is between 45 and 55% of revenue is probably a reasonable multiple. And what we found in this analysis is that's probably a pretty good number. When you get to YouTube, or once you download this report, you'll see that that generally speaking, the multiples are not, there's not a whole lot of variability to it. There'll be some peaks and a few peaks and valleys, but generally speaking, when you average it out, there's not a whole lot of change. So as we look at the privately held buyers and sellers, it is generally speaking flat, and which is good from if you're a user of, or you're trying to determine the value of your business or your client's business, that's good, because you're probably able to advise or understand that as a market multiple of revenue, roughly 50% is not a bad number to at least get started with. So let me see. I wanted to move into, when we talk about changes over time, certainly business value will change. It doesn't. What we found is the multiples don't change a whole lot, but the earnings margins do. And I think one of the key takeaways from this podcast, and I've said it many times before, I wouldn't focus, at least on the smaller businesses. I wouldn't hold on to market multiples as much as I would be focused on the earnings margins. And the reason I share that, or I'm an advocate of that, is because on the smaller business, the risk generally stays the same. Okay, it's a high risk environment, but it always has. But the biggest thing is, have you fixed the engine of the business? And if you have, then that's where you get the greatest bang for your buck. So let's just say you have a multiple of 4, all right, and you have if you increase the margin 10% on a market multiple of 4 by 10%, that's 4.4. If you have $100,000 and you increase it by 10%, you increase it to $110,000, and now you apply that 4 multiple. That's a 4 times that increase of $10,000. So you can see that the focusing on the margin will do far greater good than focusing on what are multiples doing. I wanted to show the median. What I was saying earlier was, if you look at, and what we're looking now is median selling prices to revenue. So selling price divided by net sales. You can see that the majority of, if you go line by line, and let's just take construction, for example, this is 10 years worth of data, and 44%, 42%, 44%, 46%, 42%, 40%, 42%, 42%, 46%, and 49%. So you can see that, generally speaking, we're 10 to 20% plus or minus really is that net, or that selling price to net sales multiple. And so, and that's kind of what I want to make sure that you take that away, is that, again, at this level, the multiples are not nearly as volatile as they are moving upstream. When I say upstream, upstream is the lower middle market. And the reason that the multiples change so much is because they're often strategic buyers. And those strategic buyers look at businesses different than somebody that's buying themselves a job. So when the strategic buyer is buying, there are synergies that they are willing to pay, either at, certainly probably more than fair market value. But my point is that when you start looking at the multiples that they're paying, the reason that they're able to pay increased multiples is the synergies. All right. So so the risk decreases for the synergy, and therefore the value goes up. And again, in those cases, the market data is, or the value is imputed into the multiple. So strategic and fair market value buyers and financial buyers are two really different types of buyers. I will tell you that if you're going to consider selling your business, you're going to say, well, what are the strategic buyers paying? Well, it really just depends. Oftentimes when we take a business to market, especially where it's a larger business and we expect that the only candidates are going to be strategic buyers. We often don't put an asking price on it because we don't know the value to that respective buyer. So until we confidentially take the business out and do the process, we won't know, what a strategic buyer would pay. And so as a result, that's the only way you can really determine what strategic value would be. And what I would say is, I always get pressed on, how much over and above a financial buyer is it? The rough rule of thumb, I would say, and again, take it with a grain of salt, is anywhere from, 15 to 40% over and above financial buyers. All right, so let's go back now to our multiples. So now when we're talking about the median selling price to seller's discretionary earnings, and when I say seller's discretionary earnings, it's this. This is the calculation, and in an episode coming shortly, I'm going to break down how you calculate what's called SDE, seller's discretionary earnings. But here's the formula. So you add your net income, your depreciation and amortization, and your interest. If you're a C Corp, add your taxes. And that gives you your EBITDA numbers, earnings before interest, taxes, depreciation, and amortization. You then add your officer's comp for only one officer. So you add a fair market, or you add the officer's compensation, any payroll taxes, any benefits that are paid specifically to, that owner. And then you add any discretionary or non-recurring expenses. And what do I mean by that? So discretionary expenses means, you're running, you have your kid on the payroll, and your kid, you're paying him for full-time work, but he's working part-time. Something like that. That's a discretionary expense. Your cell phone, private cell phones. If you are running any personal expenses through it. Now, by the way, I strongly encourage you to be able to prove this. Don't swag it. So don't swag. Scientific, what's the acronym? Swag is scientific wild ass guess. You do not want to do that when you're dealing with SDE. So your discretionary expenses, non-recurring expenses, like for example, business I was looking at had storm damage, and so they had a one-time event where they had some flooding, and while insurance will take care of it, they had a bunch of expenses that had to be paid, and they clearly put it on the company, and so that was a non-recurring expense. So you add that, and so when you add those four components together, you have seller's discretionary earnings. So now, when we're looking at the median selling prices, and we just did construction, so we'll keep it consistent. The multiples for construction are and this is from 2013 through year end 2022, 2.4, 2.5, 2.6, 2.3, 2.4, 2.1, 2.3, 2.2, 2.4, 2.4. So you can see, just like the selling price to net sales, it remains fairly constant, which is not to, for having done this as long as I have, that's not surprising. So, but back to what I was originally saying, focus on the earnings, not the earnings multiple, and you'll be fine. But my point is that, generally speaking, multiples stay. I want to reinforce this again, that multiples at this level generally stay fairly consistent. And it turns into the earnings as the the determining factor for value. And I would be remiss if I didn't say, business value is comprised of three things: one, earnings; two, risk; three, growth. All right. So we know what our earnings are. I just told you how to calculate it. We know what our risk is because we have the multiples. Now it's up to the buyer as far as what do they perceive as growth. And again, you probably can't get until you know who that buyer is and what they are going to do. You don't really know what growth is. There's some argument that these multiples kind of already impute growth. And in this case, I'm looking at it from the standpoint of, they just think that the business is probably, there's no hockey sticks here. They're probably just going to continue operating in the normal, ordinary course of business. And that's fine. But I want you to make sure that, you understand that, that these multiples tend not to change. And in fact, I'm in the middle of writing an article about just this, that, why at this level we hang on so tight to market multiples when in fact there's not a whole lot of change. So, and I'll keep you posted on when I release that. Okay. These multiples, again, I don't think you're going to see that there's many changes. I'm just going through these charts and want to make sure that I didn't miss anything that would be of importance. One of the things that I did want to share is that discounts from asking price to sale price, typically it's been running around 5%. But what's interesting is that in 2022, it was closer to 12%. And I say that only because I think there's a greater number of buyers that are in the market looking for deals. And I think when you start getting more activity and more feedback on the respective business, we tend to see that there's somewhat of a discount. The interesting thing is, early in the podcast, I was just talking about how high the multiples were and how high the earnings margins were, and yet we're getting this discount. Could you imagine what would happen if it wasn't discounted? So, again, it's not I share that only from the standpoint of, the more versed you are as far as what creates value in your business, the greater opportunity you will the greater chance you have of not having to discount in order to sell. Okay, the average days on the market increased to 282 days in 2022, which is second highest in the decade that's reviewed. So that, I always tell everybody, it's a 6 to 12 month ride in order to get that done. And since we're talking about times to sell, I would be remiss if I didn't share, when you sell a business, part of the sale process is the transition that happens afterwards. And what does that mean? Well, that means that, you're going to have to, provide some level of transition from the time of closing till the time the business is adequately transitioned over. And what does that mean? That only you can tell me that. I don't know, but I can tell you that anybody that's buying a business wants to make sure that the business is, adequately transitioned. And so I always tell everybody, it probably takes, 30 to 90 days to kind of gear up to sell. it takes, nearly 9 to 12 months to sell the business. And then you should probably anticipate, 30 to 180 days after that to sell. So, I mean, you're talking really about, an 18-month to 2-year process in order to effectually sell the business. So as you're doing your planning, I mean, keep that in mind. Okay, so as we conclude, market data is fairly consistent. I mean, I do think that you understanding your value is probably the most important component. When we do our market analysis, I mean, we're pulling from organizations like DealStats, and then we adjust your business based on what we see. So what I'd like, I guess, from what I want to make sure that you take away is that it's really important for you to understand the value. All right. If there are industry experts in your particular industry, that's a good person to have a conversation with on what deals, what businesses are selling for, if they know. The other thing you might want to do is avoid listening to people in the space that have sold, because they're multiple. Often business owners botch up the multiple that they that they're selling for. All right, so what they think is their EBITDA multiple, and I'll give you a perfect example. We had a company, a business owner, saying that his buddy sold for 20 times EBITDA, and there was no way. This business wouldn't pencil out. It couldn't afford to sell for 20, much less 10. And so anyway, we started digging in a little bit on why that was. And at any rate, one the multiple that they used, the EBITDA, it was a net income multiple, not an EBITDA number. And on top of that, it was an unadjusted EBITDA number. So my point to you is that you need, most of the time, the mistakes are you don't know the context of the multiples. And so from where I sit, those are the things that I want to know. Is this is empirical data. I can go in and I can say, this is what we have. This is what it shows that businesses are selling for. Here's why you're above or below what is selling for in the market. Now, when we go actually take the business to market, that's a different story. We may have strategies to capture strategic buyers, private equity groups, things like that, where we take off the asking price, because they're professional buyers. They know they're going to have their own value and how that business, is how that business is going to be a 1 + 1 = 3 type business. And so from our standpoint, we just want to make sure, and the last thing I'll share is that I can tell you that 87% of the people that do any kind of value work, at least from out of this shop, and we've done over 2,200 deals, I will tell you that they sell because they understand what the buyer's looking at. So as we conclude, understand your value, whether you're selling or whether you're considering selling down the road. It's always good to understand what levers to move in order to increase your value. If I can help in any way, shape, or form, I will always let you know when I have to turn the meter on. But I get emails every day of asking different things about value and the market. So we have an open shop, and like I said, we'll let you know if we have to turn on the meter. So thanks so much for listening, and I'll see you next week.
Thank you for joining us today on the How to Sell Your Business podcast. If you want more episodes packed with strategies to help sell your business for the maximum value, visit howtosellabusinesspodcast.com for tips and best practices to make your exit life-changing. Better yet, subscribe now so you never miss future episodes. This program is copyrighted by Myso Inc. All rights reserved.